by default.
Start at 2:30. Just let the attendees in.
Yes.
Okay. Hi. Good afternoon. Good afternoon, everyone. We have about 80 plus participants as of now. We'll just give it a minute more, and then we will start with today's webinar. Uh, FIDC, as you all know, needs no introduction. We are Finance Industry Development Council, the RBI recognized SRO for NBFCs and HFCs. So all types of NBFCs uh, are a part of our SRO regime right now. We are doing these monthly webinars for the past 4 months, and we would continue to do this on a monthly basis, bringing you all various topics of interest and key topics that are topical in nature, basically to ensure that you are aware of whatever are the new things, new developments impacting you from a compliance, legal, regulatory perspective. Today's session, it's a 90-minute session. The first 30 minutes will be a session by a legality team. They will be walking us through the Consentin platform they have specifically to address the DPDP related implementation. So that's the session where we are saying DPDP made practical with Consentin by legality. The second session will be for an hour, which will be focused on governance. We are starting with these governance series. And today's session would cover stuff around the structure, org structure, committees to be formed, role of KMP, SMP, rules around KMP, SMP, etc. So it will be insightful for everyone who's attending the session. We will leave some time for Q&A. With no further ado, I think we can start. It's already 2:33. I would like to invite the legality team. We have about 104 attendees and counting. So legality team, you could start sharing your screen. I'll, in the meantime, introduce our speaker today from legality, Mr. Pushkal Dubey. He's head of consent infrastructure at Consentin by Legality. Pushkal is a former privacy lawyer at Trilegal, whose advice on global privacy regulations, including India's DPDP bill. He's now building compliance products for BFSI and also serves as a judge for NEGD's DPDP Innovation Challenge. Over to you, legality team.
Pushkal? Thank you. Thank you, Priya.
Before that, Pushkal, please ask the participant if they are able to hear it properly, if somebody can raise their hand.
Yeah, we can hear.
Okay.
Okay, great. So I hope my screen is also visible to everybody and yes, I'm audible also. Yes. Okay, thank you. Thank you, Priya, for that intro. So yeah, today, what we want to do with you all today is to have a practical discussion on DPDP compliance. I think at this stage, a lot of the questions are about how are we going to pull it off. And at the end of this discussion, my goal is that I'll be able to give you some practical insights or practical takeaways where you get some sort of a beginning of an idea as to how you would, what steps you would take to undertake DPDP compliance. So as Priya said, I am a privacy lawyer as well as a product manager. I've been involved in judging the NEGD code for consent competition. I work at Consentin. So Consentin is a product by Legality, and Legality, started off in the document infra space. We have a very special skill set and competence expertise in compliance tech products, especially for BFSI. And Consentin is our second product, and it is being used for an organization-wide implementation by IFL Finance. And most recently, we have started the biggest privacy implementation in the country with the Union Bank of India as well. We are also working with Shriram and Payments and Jana, many other such entities. So that is about Consentin. Now, today, as I said, I want the discussion to be super practical and applied. So we have covered, why NBFCs need to comply and what are data categories and those aspects. But we'll keep that in the presentation and we'll share the presentation with you. But I want to jump straight into the key timelines because I think that was one of the questions that we got before the webinar as well. Um, but before I dive into it, I'll try to keep this presentation, just a note on the structure. I'll try to keep this presentation really brief, and try to end this in about 15 to 20 minutes, along with some brief demos, etc. And I'll try to leave some questions, some time for at the end for questions. So if you have any questions while I'm talking, just drop them in the Q&A, and I'll go over those questions as well as, I'll be able to take any more ad hoc questions as well, after the 15-20 minutes. So yes, coming back to the presentation, firstly, there are some key timelines that have come in with the rules coming out as recent as last month. The Data Protection Board has already been formed for consent and the key obligation here is that there's an 18-month compliance window for data fiduciaries, and their obligations kick in on 13th May 2027. So there is an 18-month window, 1 month of which is already gone. So now you have 17 months to become fully compliant with DPDP. There was another question in the pre-webinar questions, which was, can someone simply explain what DPDP Act is about? And while working in this space, this is something that I particularly enjoy doing. So here's a simple explanation for DPDP. The Act is asking you to bring in transparency, trust, and control, right? It is essentially a consumer protection law. And what it requires you to do is bring in transparency about how you process data and give control to the end users, and also for yourself as a business to get that control about how that data is processed, and also bring in trust in your processing, which is make the data safe that you're processing, make that processing safe, right? So when we think about where to start, it is very good to understand the goal, right? What are you, at the end of the day, what are you trying to achieve, right? And what does this transparency and control mean in an applied sense, right? So with that, let me jump into a demo. So let's say somebody comes in to fill a gold loan, to get a gold loan, right? They would fill in an application form. And now this can happen across multiple channels. It can happen through agents. It can happen over WhatsApp, etc. I mean, in gold loan specifically, it happens at a branch, but a lot of onboardings, other onboardings can happen in a lot of flows. So consent collection should be integrated across all of those flows. And this is what a notice looks like, right? So your notice, and at the immediate outset, you see that all the purposes are listed out. What all data categories are being processed is listed out. Marketing and promotions is an optional purpose to which I can provide my consent. I'm told how I can make a grievance or how I can submit complaints to the board. I can also translate this notice in all of these languages, right? This is step one. This is transparency, right? This is what it means to be transparent with your end user, with your customer. And at the first step, and then now I can say that, you know what, I don't like marketing and promotions communications. So I don't want to provide my consent for that. And I, accept the limited consent and I move on. This is what control feels like. So I am able to select the purposes for which I want to give my consent, and where I don't want to give my consent, I can withhold it. That is, I think, the easy part. The difficult part is to orchestrate this across your entire ecosystem, including your third parties, and that's where Consentin helps you. But sticking to the end user journey, I will go on and upload my details, etc. And I can also at any time manage my privacy, right? So if I manage my privacy, I get this sort of a login where I can update my preferences. So this is an example of that. I can, for this event invitations, this is a separate consent that I'm managing. And here for event invitations, I can see that I have revoked my consent, granted, revoked, granted. I can see the whole trail. I can get this downloads of, the consent artifacts and the consent records and the notices. I can see the privacy policies and all of that. And I can also update my consent, right? So I can also raise requests. So I can say that, I have a grievance with how my data is being processed. I'm getting too many calls, and I can raise these grievances also through this platform. And this provides me like sort of an end-to-end interface to manage my preferences, manage my rights, and manage my notifications and all of that. So this sort of portal gives me that control uh, to be able to manage how the business processes my data. And as a business, it's your job to give this control in the hands of your customers, right? Now, we analyze these aspects of a notice, right? It was clear, it was available in vernacular languages, purposes and data were clearly defined, links were given, it was downloadable and all of that. But this is the, as I said, the easy part, right? The difficult part is how do you make sure that data is processed based on the consent that is collected from the end users, based on, let's say, detention and deletion timelines, or based on their requests, or based on any other events that happen in their journey. And that is where Consentin comes in. Consentin orchestrates PII governance, and it sits in the center of your upstream systems, which are the systems where you're collecting data, such as your website, your LOS, mobile app, etc., and your downstream systems, which are the systems where you're using data, such as your analytics cloud, your marketing cloud, your BRE, etc., your CRM, and all of that, right? So these downstream systems receive signals, alerts, instructions from us. They can integrate our APIs and a lot of other integration methods, essentially to find out whether they have consent to go ahead and perform the operation that they are going to perform. So that is how you can ensure this control across your entire ecosystem. And but this is what control, this is how you can achieve control. But then the next question is, how do you get here, right? Sounds great in principle, but how do you achieve this level of visibility within your organization? And the answer to that is that your goal is essentially to get to this data mapping, right? And this data mapping is what is facilitated by Consentin. So here, this is our Consentin application. And here you're seeing, let me just pull out an example. So if I look at that gold loan journey that I showed you, or maybe we can also look at another example for MFI. Yeah. So if you see this gold loan journey, this is what your internal visibility looks like, right? You need to understand what data are you processing in what system, for what activity, and for what purpose, right? So if I look at this MFI, and if I look at what data am I processing for customer onboarding, I do credit check, fraud check, KYC. And for KYC, what are the systems that I'm using and what all data categories are being used? Similarly, for fraud check, what is the system that I'm using and what all data categories are. So your first step in this compliance process is to develop this sort of a data mapping. And once you have this internal data mapping, only then can you pass on the control to your end users for this. You can bring the visibility that is required, that the law requires you to bring in, right? Now, how do you do that? How do you achieve this data mapping, right? You have so many disparate systems, you have so many disparate processes, different departments who are doing different things. How do you do this massive data collection exercise of what data you're processing, where are you processing it, what are you doing with it, and for what purposes you're using it, and whose data is it? So the first step here is to do data discovery. You can use something like Lens. So Lens is our Consentin's data discovery product. It is entirely on-prem and largely agentless. It sits within your system, and the entire control center for this is also within your environment. It can be your cloud or your private data center, and it gives you this visibility of what are the sources, what are the data categories that are available within different data sources. So if I look at these data sources, I see that there is a lot of concentration of PII in RDS Aurora. Or if I want to look at Oracle, I find out that these data categories are there in Oracle. Let's say if I want to look at where all email is there, I find that email is there in this particular table. And here number of instances found, and you get to see samples, you can generate reports and all of that. So this whole thing creates a data catalog where you find out that, okay, these are all the systems, these are all the data sources where I'm processing all of this data. And you can find this out by running scans, and scans can be done entirely automated. You can have a lot of configurations as to when the scan should run. You can upload your credentials, and bunch of configurations there. You also get detailed activity logs and detailed user access management and all the bells and whistles of a self-hosted, self-operated enterprise product, right? So all of this you're able to do directly from the application without any dependencies on us. And this is our data discovery tool. And coming back to our initial sort of exercise, that okay, now I did data discovery. I found out what data I have in what system. So these but and what you see on the screen right now are a bunch of things that you have to keep in mind. So your data sources can be structured and they can be unstructured, so like a lot of surprises you're going to get when you look at your Google Drive, right? Or when you look at your mail server. So here in Lens, you see that in Google Drive, you have all of these data sources, Aadhaar card, Aadhaar numbers, and all of that. They are sitting here, and you can scan all of these structured, unstructured data sources. You can scan your endpoints, etc., to get this visibility. Since there is sensitivity of data, you have to identify what data categories you have, what systems you're using. These are just some things to keep in mind. I won't spend too much time here. You can go over this when we share the presentation, or maybe I can go deeper based on the questions. Now,
So there's
this
just
is
one basic
yeah,
question, Pushkal.
yeah,
Basically, if you can give examples of few PII elements, like what constitutes as personal data
got
for
it.
specifically in the context of DPDP. Just a few examples for.
Sure. So, that is, there are some obvious answers to this question. For example, your name, date of birth, photograph, Aadhaar, PAN, voter ID, like your device details, etc., that are uniquely able to identify you as who you are. So, in my case, as Pushkal, are personal data. But this is the obvious stuff. The devil lies in the details when you look at non-obvious things, right? And when do you know any data is personal data? And the best example is an internal customer identifier, right? You can assign an internal customer identifier to your customers. Now, if that customer identifier is taken out of your system, then and if somebody else is using it, they don't have access to any data in your system, it would not be personal data for them. But within your system, with the context of all the relationships that you have against that customer identifier, it constitutes personal data. So the answer to what constitutes personal data is contextual, and it is also based on the purposes for which you will use the purposes for which you use personal data. I already told you how it's contextual, right? Because if there are other relationships, then that becomes personal data. Now let's look at the purpose part of it. So let's say you are using some innocuous identifiers, which are not by themselves capable of identifying somebody. For example, their PIN code and their income group and their spending history are the locations at which they're spending, let's say. If you're using these identifiers to create a very highly personalized profile of the person, then maybe in other contexts or maybe for other purposes, it may not be personal data. But because you're using all of this data to create these highly personalized profiles, you're using these data to identify the person. That's why it becomes personal data, right? So we often get these questions as to, when are we going to get a list of personal data? That's not going to happen. You're not going to get a list of personal data. You're just going to have to do the evaluation yourself as to whether what data you're using is personal data. The reason for that, as I said, is because personal data, there is obviously some personal data which is by itself can identify a person, but also the answer to that is very contextual in the sense that what all data is available along with it. And also it is based on the purpose for which you're using the data, as in how are you putting all these data elements together to create these profiles. So yeah, I'll quickly wrap up my presentation. Um, so we were at data discovery. We were at where we were identifying these personal data. So on data discovery, then okay, fine. Data discovery. In order to start off data discovery, you have to have this list of data categories, right? You have to be able to know that okay, this is what I think is personal data, and you can define those data categories over here. With Lens, you get a lot of them out of the box, and identification of the data category is a science in itself. We use pattern recognition, we use classification models, we use a lot of workflows to ensure that your false positive rates are minimized and we are able to accurately identify personal data. So, not getting too much into that. But now you know what data is in what system. The rest of the part is you need to understand what are you doing with, right? And the best way to understand what you're doing with it is to sit across from your system admin, is to sit across from your process admin and your business owner and ask them this question: what are you doing with this data? The process of asking this question is called an assessment, right? So you can do gap assessments and DPIAs, which will help you identify these processing. So you can do that using Consentin. So in using Consentin, you can trigger these assessments and manage these processes where you ask these scoping questions and get these responses from different responders. We've been talking to a lot of leaders in the BFSI space from the largest banks, and the best way to do it is to talk to different owners about similar processes and unearth the scope of those processes. So here I'm looking at Razorpay as an entity, and I find out that okay, Razorpay maybe also be used for a processing activity of document signing. Maybe there is some payment that I have to collect to sign the document, right? Which is something that I may not know by myself, like when I'm just intuitively thinking about it. But in this process, I find out this information and I can add that to the scope. And everything gets automatically added to your ROPAs. And then your ROPAs finally go on and inform this data mapping of yours, right? So which we have created over here, which we started off this presentation with, right? So slowly you ask a lot of these questions, and then based on that, you can go ahead and create this data mapping. So the flow for creating the data mapping can be done through the profiles, but I will not get into that, seeing that we are out of time. But another thing that you can do with assessments is to identify your risks, right? And to mitigate those risks. And this is where the trust aspect comes in. So the law is requiring you to identify risks and implement controls to fix those risks, implement mitigation measures. So as a whole, your data principal, who's your end user, who's your customer, can trust that you're keeping their data safe, right? So this is the process that very briefly helps you bring in transparency, control, and trust. And if you're able to bring in those values within how you use data across your entire ecosystem, you can broadly be confident that you're complying with the law. There's a QR on the screen. If you have any more questions, please scan that QR and we'll be happy to take those questions, have in-depth discussions. But now I think I have 7 minutes more. So I'll be happy to take questions even like that.
Okay,
Yeah.
so Pushkar, if I may jump in, and thanks for this informative presentation. Now let me come to the actual practicality. Let's take the same example which you said about a gold loan journey. Suppose I am a gold loan borrower, and you are an NBFC. I come to you, and all this what you have just explained is fine. Now there are two aspects to it. Today, as per the regulatory framework, there are a lot of sharing of data that happens as part of the regulations. It could be directly to the regulators, or it could be some third parties as identified by the regulators. So, for example, all the CICs. Okay, now the data has to go to all the 4 CICs, right? Similarly, then there is a central repository called CRILIC, index of large exposures. So that data has to be shared to them. So the point comes is, and it is not, if you, whatever we may say, it is not possible to identify each and every at the beginning itself, at the time of signing the loan agreement or doing this case. So how do we take care of such eventualities? That's number one. Number two, which is even more trickier, is this whole issue of right to revoke. Now, as I see it, and with my personal experience of 33 years, this has a huge potential of, if I may use the word, misuse or abuse. So, for example, any defaulter will go ahead and revoke his right to share that data and then challenge in a court of law that whatever action you are taking against me goes against, because I have already revoked this my right to share that data. So I think that is something which to me sounds a very kind of a gray area, unless you can specify something which clarifies that point.
Absolutely. Thank you so much for that, Raman. So Yeah, so these questions are dealt with in the law itself, right? So let me, you have raised two questions. How do you deal with the reporting requirements, regulatory reporting, lawful disclosure, and all of those requirements? And secondly, what if, what about revocation in the case of defaulters or collections or where I have an ongoing dispute or a litigation or something like that, right? So to answer both of these questions together, and then we'll deal with them one by one. Consent is largely the basis for processing data, most of the data that you're going to process. However, the law carves out a bunch of exceptions to that, right? Those exceptions, if you look at the act there in the legitimate uses section, section 7, or in the exemption section, which is a separate section, which exempts some activities. So if you look at these sections closely, you find that if you have any lawful disclosure requirements to any regulator or to any law enforcement agencies or any reporting requirements to your RBI, etc., those are exempt from consent, which means that consent is immaterial to you making the reporting. In fact, there can be cases where you may have to retain the data for a longer retention period. So, for example, KYC data you have to retain for 10 years after the close of business relationship or something like that. CIC data, credit check data, you have to retain for 7 years after you did the credit check. Right. So here, even if the customer has closed their account, come to you for erasure and ask for erasure, you must retain that data for a legal retention period, and that is also carved out as an exemption from your erasure obligations, right? So this is about reporting, regulatory reporting requirements. Defaulter is a very specific and very another example of that exemption. So if you look at the exemption section, financial debt collections are excluded from the scope of consent because we don't want people to come in and say, "Oh, you cannot process my data for collection," right? That creates a very difficult situation. So that carve out has specifically been made in the exemption section. So there are other very business sensitive carve outs that are made that may not be relevant for this conversation. For example, business process outsourcing call centers that are sitting in India, they are carved out from DPDP requirements. So these business requirements are specifically called out and carved out within the act. And then when it comes to revocation or deletion, the retention requirements that are prevailing in any law for the time being in force or any legal notification are also carved out from deletion obligation. So that is how that would work.
So there's an
And
interesting question
yeah.
on the chat. The act pertains or act says digital personal data protection. So does it apply to any data, which could be personal data, but it's collected in a non-digital manner? Does it apply to? No.
Yeah. So data that is collected physically and digitized subsequently.
Digitized. Yes.
That there it applies. So if you collect data on a paper form, as long as it's on the paper form, it's not personal data. But as soon as you digitize the data, it becomes personal data. And this creates a bunch of offshoots, right? Does that mean you can collect consents on a paper form? Yes, you can. But since the processing of data is digital, it is a really bad and risky idea to collect those consents on a paper form because how are you going to digitize it? And how are you going to maintain, how are you going to do governance based on that? Another example that a lot of people say in jest is that okay, let's just move back to paper forms and let's not keep all our data on paper. But of course, that it won't work. So data that is digital or digitized subsequently, collected physically and digitized subsequently, is covered under this law. Your consents can be physical, but they should be digital as much as possible.
Thanks, Pushkal. One more question and possibly the last, given the paucity of time. But any other questions, feel free to write to us and we will try and answer them separately. For personal data collected before the act, what is the practical way to continue with a reconsent, team consent, or any purpose-based use? So what do you do with the already available collected data?
Right. So a great question. The law creates a carve out for that also. There's a section. So the law basically says as soon as it comes into force, May 2027, after that, all the data that you're processing, you should collect consent for it. Before that, all the data that you've collected, you should send a one-time notice. Now, the legal difference between one-time a notice and a consent is notice is just info. You're just telling people that I'm doing so and so with your data. whereas a consent is a acceptance, like it's a two-way sort of acceptance of how the data is going to be collected. So if you have collected data before the law came into force, you are supposed to send a notice and give the end user, the data principal, your customer, an option to withdraw their consent. So to bring them in line with the data that is being used, you know, with the data that has been collected after the act. Now, here, a lot of legal experts in the audience would be a bit uncomfortable because Section 5.2 is worded in a way where you should collect consent, where for consents collected before the law came into force, you can send a one-time notice. So, what do we do if we have not collected consent before the law it came into force and we are still processing the data? That becomes a question. Now, again, we've spoken to a lot of industry experts and we've spoken to a lot of people who are making these decisions, and everybody seems to be on the same page that we are going to just send a one-time notice for all the data, because collecting consents after you have already processed the data is logically a bit absurd. So logically, the only thing that you can do is send people a notice and give them an option to withdraw their consent. This seems to be the consensus on this topic.
Got it. Got it. Thank you so much, Pushkal, and the entire consent and legality team for this wonderful presentation and the time you've spent with FIDC members. I'm sure there are lots of questions, and for the members, this is not the first session of DPDP we've done. We've done an earlier session last month also. We had covered the technical knowledge about DPDP through another partner, and we'll continue to host this. There is 17 months left for us to roll out this. So that's enough time, and whatever questions you have, FIDC is here to answer that for you. Just reach out to us separately. Thank you so much, Pushkal.
Thank you, Priya. Thank you, Priya, and thank you everybody else for this session.
Thank you. We'll move on to our next session now, which is completely focused on RBI governance in particular. So one of the tasks that FIDC is assigned is empowering self-regulation, right? We are a self-regulatory organization, and we have to empower our members to also self-regulate themselves. And how do we do that? We do that through building trust-based governance, compliant, and compliance. So in that context, we have the second session. This is for an hour now because it is a technical session. It will cover governance and NBFC resilience, overview of the RBI requirement, particularly the newest consolidated master direction that has come on governance. It will talk about KMP, SMP, board committee formation, org structure, and some insights also into the practicality of how the RBI inspectors, particularly the Department of Supervision, which are the areas they would focus on. So we hope that this would be a very insightful session for you all. Over to our speakers, but before I let them begin, I would just like to share my screen. Just give me a minute. I hope you guys can see the screen. Is the screen visible?
Yes, it is visible. Yeah.
Okay, thanks, Sarthak. So yes, we have with us actually two main speakers. Aarti Shekhar, Senior Executive Vice President and Chief Compliance Officer for Kotak Mahindra Prime, and Yogesh Jain, Chief Compliance Officer, Godrej Finance. Both of them have decades of experience in the NBFC sector and particularly in the compliance and regulation space. I don't need to give too much of details about their biodata. It is all right here. But just a quick look into their individual sort of journeys. So Aarti spent about 25 plus years in banking and financial service, specializing in governance, risk, and compliance. She's also worked with ICICI Bank in her earlier roles. She's a chartered accountant as well as a qualified certified internal auditor from IIUSA. She's supported various roles in her 25 years in banking, and particularly within Kotak, she's also worked in the bank overseeing multiple functions. Yogesh has much diverse sort of an experience more in terms of the companies and the organizations he's worked with. As you can see, he's got 15 plus years of experience across working with the regulator, public sector banks, HFCs, and NBFC segment. He's got deep expertise in compliance and regulatory affairs. He serves also on various POSH disciplinary and ethics and crisis management committee. Governance specialist advising boards on building compliance positive organizations is one of his key passions. And he supports us extensively on the FIDC aspects. And I would like to also basically share with all the members here that Aarti and Yogesh both are part of FIDC's capacity building committee. Both are the co-chair of our capacity building committee. All our committees would be live and working. They are already live and working, but from January onwards, all of them would be in full in force. And there's a lot of action that you would see happening on all fronts from FIDC. Over to you, Aarti, Yogesh. I'll
Thanks,
just
Priya.
do the slides share.
Yes. Thank you so much, Priya, for that lovely introduction. Very humbling. And warm welcome to the FIDC team, Mahesh Thakkarji, Ramanji, Pooja, Priya, as well as the other team members. Also to all the wonderful participants. We hope that this session would be a value addition, furthering the capacity building objectives that Priya just mentioned. Yeah. Could we move to the next slide, please? Okay, since it's a post-lunch session, I thought we could start with an interesting anecdote, okay? Who packed your parachute, right? Many of you must be skydivers or something like that. I read an interesting story and I thought it kind of went well with our topic today. There was a story of a person called Charles Plum. He was a war veteran in the Vietnam War and he was a pilot. So his plane got bombed and luckily he, jumped off the plane, put on his parachute and he landed safely. He spent some time in a communist prison, but eventually was released. One day he was having dinner with his wife at a restaurant and somebody walks up to him and says, "You are Charles Plum, right?" And he says, "Yes. How did you know?" He says, "You were in the Vietnam War and your plane got bombed." He was very shocked. He said, "How did you know?" He said, "Sir, I'm the man who packed your parachute every day." Right? So Charles Plum was taken aback because he said, "I never have even seen this person. I've never greeted him. I don't know who he is, but he did probably the most important job, which was packing my parachute, because if he had not packed it well, I would not have survived that day." Just drawing a lesson from this, I think, is that all of us in some way are parachute packers, right? In our respective governance roles. So I think it may not be one of applause, it may not be one where we get medals, but it's a very, very crucial role, right? So with that in context, we could move to the next slide. Corporate governance, very deep subject. I'm sure that a lot of you participants are experts in it, but just a little bit of definition, set of rules, practices, and processes that governs how a company is directed and controlled. Just a basic definition. So it's written rules, it could also be practices and processes. Quickly on the 4 pillars of corporate governance: transparency. We all understand this, openness in communication across all channels, right up to the board level. Accountability, everybody is answerable for their actions. Fairness, we treat all our stakeholders equally. And ultimately, responsibility, because we are fiduciary entities and hence we act with responsibility. We are regulated entities, right? Legal framework, I've just put the main key legal regulatory framework, which is for us the Reserve Bank of India, the Companies Act, as well as SEBI related regulations as applicable. Without spending too much time on this, moving to the governance guidelines given by RBI. As you all know, earlier there were the scale-based regulations, which recently in November, RBI has come up with fresh set of guidelines and circulars, and certain old circulars have been discontinued or superseded. So the 20th November is what is effective. So all the earlier guidelines have kind of come into a single document, which makes it easy to reference. Continuing the principle that RBI follows in the scale-based regulation, there is a progressive set of requirements depending on the layer you belong to. So if you're a base layer, there is a certain set of basic requirements. If you're a middle layer, a little enhanced requirements, and in case you're an upper layer, then requirements further go up. So it's a very tiered structure and well thought through by the Reserve Bank. The key areas that RBI touches upon in these circulars would cover the board committees, the key management personnel, the senior management personnel, as well as policies and various other aspects, which we will be covering in the slides to come. Over to you, Yogesh.
Yeah. Hi, thank you. Hi, good. Welcome everyone to this session. I would just like you to pay attention to this slide where we have tried to capture the governance structure as is applicable at least from middle layer onwards. So if you see this structure, obviously, like in all organization, board of directors sit at the top, right? That does not mean they just sit and do nothing. There is one of the most crucial job. They are supposed to guide, set up the processes, put up the review mechanism, and ensure that the entire company is operating in a proper manner and as per the extant regulation. How they get help is through multiple committees. Some of these committees have specifically been asked by the, please remain at the previous. Some of these committees are required to be constituted as per either Companies Act requirement or RBI or both. We'll just take a very quick look at some of these committees and then deep dive later on. At the first layer is the Audit Committee, Remuneration Committee, and Risk Management Committee. These three committees are, I would say, one of the most well-known committees because most of the companies which are not even NBFCs have these committees. Risk Management Committee obviously is a newer entrant for non-financial services player. The other important role with these committees take is that important functionaries like Chief Compliance Officer and Head Internal Audit have a sort of reporting to Audit Committee and Chief Risk Officer to Risk Management Committee. There is a requirement to have an IT Strategy Committee also, which also in turn has a IT Steering Committee and Information Security Committee. Customer Service Committee is relatively new entrant. If you remember, the Credit Information Reporting Circular had references to Customer Service Committee. There are internal ombudsman guidelines which are applicable on NBFCs with 5,000 crore or more asset size. This is also a committee which sort of take care of all matters related to customer service. It is coming under a lot of attention, especially because customer areas are being taken very, very seriously by the regulators and by the board of directors and other stakeholders. Asset liability management committee, I would say, one of the major operating committee. I find it to be most active in most of the NBFCs or banks where I have worked with. This is a committee which basically decides a lot of things. There is also a famous saying, right, which says that your cost of fund decide your cost of risk, and your cost of funds get decided by this ALM committee. So this plays a very, very important role. Product committee, again, a new entrant. This committee was first talked about in a Chief Compliance Officer circular where it was talked that a product committee is required and CCO need to be a member. Earlier, some of these functions were done on ad hoc manner or they were done either through credit committee or through some other committees. Now, product committee is taking shape. It is bringing a lot of discipline into the operating principles. Willful defaulter committee has obviously come up from the recent circular which was issued for willful defaulter guideline. Some other committees which are required, internal committee, which is a POSH committee, special committee on fraud, which is required as per fraud risk management circular. Whistleblower committee is usually a part of the vigil mechanism. Again, this plays important role. There is a lot of interplay between special committee on fraud and whistleblower committee and audit committee. We find a lot of interoperability in these committees. Then there are certain companies which make some specific committees. So there is no bar in having any other committee which company may have. A lot of companies have loan and investment companies. Some have borrowing and investment committee. Some also have credit committees, which while may not necessarily be required by regulation are there. And to all these committees, in a way, the various KMPs and SMPs of the company work with, respond to, sometimes they are member of these committees also. So this is the broad governance structure which sort of defines the way a company works. Priya, can we move next? When we have talked about the board and committee, we also need to talk about directors. Now, directors, first we need to understand when we are making a board of director, we need to focus a lot on the composition. How a board gets structured decides a lot of things. Ideal board would be a board in which there is a mix of independent, executive, and non-executive director. All three types are must. There are some companies which have only independent and non-executive director, and sometimes executive directors are not made part of the board. While it is not regulatorily required, we have found a supervisory team taking a view that there is no operating person at the top of the affair. That is also something which we need to take into account, that now there is a requirement that one director must have prior experience of banks and financial services. While this was being done by most of the NBFCs suo moto, RBI has specifically brought this condition. This condition anyways was applicable, I would say, in some way through the bigger NBFC where audit committee is required, which is 10 crore and more from Companies Act perspective, because audit committee chair need to be well conversant with the reading of financial statement. So what RBI has basically done is they have put a lot of regulations which were there either in Companies Act or in some other way prudently followed by most of the people, and they have put it as part of the guideline. I would also like to say that when we are reading this circular, the governance guideline, one thing which you must remember is that the guidelines are not the ceiling, but the floor. This is something which we as compliance professionals must always be fully aware of. A lot of time we feel that if we have complied with all the requirement of circular, that's a 100% job. Unfortunately, it's not. Complying with all the things which I mentioned in circular will usually lead to a 65% score. That is 2/3 of the job. Because RBI and stakeholders are very clear that these are the minimum standard which we need to follow. If some of you will remember under fair practice code, it is specifically mentioned that this is a minimum kind of performance behavior and standard which is expected of regulated entity. Similarly, with governance guideline also, I would like to say that what is mentioned in the circular is minimum. When they say one director must have prior experience, ideally it should be more than one. Ideally, at least the majority of the board or 2/3 of the board should have prior experience with banks or financial services, because without it, to run this kind of a unique company is tough. The next point I would like to focus upon is fit and proper criteria. Again, a very, very common thing. A lot of time it becomes a kind of a tick box item for multiple reasons. One reason is most of the time people who need to fulfill this fit and proper criteria, which is either directors or senior top executive, there is never a doubt that they are fit and proper for this job, right? When you've got people who have worked in industry for 2-3 decades, know inside out, are market players, sometimes it looks almost puerile that why should I do a fit and proper test? And how can I prove that this guy is fit and proper? Everyone knows that there is no one better than this person for this job. But that's not how things work. Regulators always expect a demonstrative evidence recording and demonstrative effort. So what you need to do is when you are conducting this fit and proper criteria, it is better if we can break it down into 5 or 6 parameters. Now, those parameters could be very simple. It could be the number of years of experience in banks and financial services, expertise of a particular area which is related to an NBFC, whether there has ever been any criminal action or any kind of action related to the integrity against the person, whether the person has worked with the company or not before, whether there is any conflict of interest with the company. You can make these 5-6 criteria, and basis that criteria, we can give a scoring to the candidate and then complete this fit and proper submission. Why this is also important is this fit and proper criteria sign off is required from the nomination and remuneration committee and then from the board of directors. So it is important for us to clearly demonstrate that our directors and committee members have done their due diligence. If this is not amply demonstrated, then question may even be asked on whether they are doing their job properly. Conflict of interest, again, is something which is much talked but very less defined. Nothing could be a conflict of interest and everything could be a conflict of interest. A lot of time it depends not from where we are sitting, but from where we are looking. So this is also, I would say, sometimes becomes a very, very black area. As company officials, we feel that there is no conflict of interest, but external stakeholders feel it is. That is why it is very important to judge our action with an outside lens, with a third party view, that had this action been done by some other company, what would have been our view, right? So this is also something which we need to sort of take into account. There are few compliances which are very well known. We need to have a annual declaration from the directors. We need to execute a deed of covenant before they become our director. There's a quarterly reporting required to the RBI with respect to any change in the directors. Annual auditor certification is required on any changes of the last quarter. These are pretty common requirement. Most of the people are aware of them, but we thought that it would be better to reiterate. Priya, we can move to the next one. Some of the governance requirements which are placed upon the board. An important requirement which is placed on the board of directors is under PMLA. PMLA is basically Prevention of Money Laundering Act, which basically says that we must have two senior officials designated either as a principal officer or a designated director. Now, again, at the face of it, they look very, very straightforward. A lot of time questions also get asked that who is the perfect candidate for a principal officer. There are many kind of different approaches which are being used for it. In bigger companies, there is entirely a separate office for principal officer. Banks especially have a totally entire setup for principal officer, who's a senior person within the hierarchy, who's a separate team and separate reporting line. NBFCs are yet to reach that level of maturity where a separate principal officer is there. I find very few and far NBFC which have a separate dedicated principal officer. A lot of time there is sort of a dual hatting. Some of the people who are also taking care of other responsibilities are given this responsibility. I've usually seen three common candidates for PO. One common candidate is CCO. Obviously, if it is a compliance requirement, better to keep it with the CCO itself. In some companies, CFO is also a common candidate for PO. After all, it is a matter related with money, so why don't give it to CFO who knows everything about money? In some organizations, I've also seen CRO being given this responsibility, which frankly was a surprise to me. I would rather advocate that if it is possible to have a separate PO, that always serves best. If not, what I've also seen is in some cases, CFO being given a PO responsibility, flags being raised. Because again, sometimes questions are being raised on conflict of interest. Because they are working with most of that monetary transaction. The question is, can they be a watchdog for it? So there is no clear-cut answer for it. There are very good arguments for and against for this matter. Designated director, again, it has to be an executive director. There are some companies who take a view that a non-executive director can also be designated director, independent director. Also, some people may take a view, but it has to be an executive director. The definition also is very clear on it. Some of the review areas which are required: conformity with the corporate governance standard, composition of various committees, their role and function, periodicity and compliance with coverage and review function. Now, these are the areas which get very much reviewed by the RBI inspection team. These are part of the management and the system and control section under CAMELS. Again, most of these are qualitative. And what also happens is we see a lot of time people saying that we took so much of effort and still observations came in. The reason being because the intent of RBI, like any good regulator, is to push us further. Board is required to review progress in risk management system, policies, various strategies. A whistleblower mechanism need to be set up. There need to be a report on compliance with fair practice code and grievance redressal mechanism. Grievance redressal mechanism is in fact becoming more and more important. A lot of guidelines are being issued, a lot of penalties being levied for not being done properly. KYC policy, risk assessment and adherence is again a very important area. Oversight on compromise settlement and technical write-off. This was a circular which was issued 2 years back. Again, gaining a lot of traction, a lot of importance being placed on it. And status of compliance with RBI inspection observation. This is a very important area. A lot of time, I have seen inspectors raising observation that the agenda item was not placed. B, agenda item was placed, but it was not properly information given. C, information was given, but it was not discussed. D, information was discussed, but it was not proper. So there are many hoops for us to fly through. Let's move ahead.
Yeah, so just one small interjection. We have Mohinder Kumar, who's also joined us on the panel. So just for the audience, Mohinder sir is got about 40 years, almost 4 decades of experience in RBI regulations. He's worked with RBI for close to 32 years. And in his stint with RBI, 19 years, he's done various senior leadership roles across multiple, functional areas within RBI. He's also been part of multiple working groups and committees and continues to be very active, particularly in the space that we are, which is NBFC. So we're very privileged to have him here today, and he will participate during the Q&A and as and when I think, sir, you may want to chime in.
I think he is also the advisor to FIDC and whatever good thing
Yes.
NBFCs are doing because of his policy formulations. Welcome, sir.
Yes, sir. Thank you. Over to you.
Thank you.
Some of the key yeah, sir, you wanted to, you were speaking.
No, I said thank you.
Some of the key expectations from RBI lens, audit committee, internal risk-based, internal audit, risk-based internal audit, review of compliances. Compliance testing is again becoming an important area which is being reviewed in detail. There are companies which are now forming separate compliance testing wing. In some companies, compliance officials are also doing compliance testing. And business teams are cribbing that there is one more auditor for them. Realities with which we all live with. Review of performance of head internal audit and CCO. Risk management, enterprise risk was, I think, very well evident and being done by most of the company. Operational risk is also being talked about. I think one of the major risks which is being faced by everyone. ICAP review is also becoming a major part of it. Performance review of CRO. Nomination remuneration committee, one area which I would like to talk is succession management. Most of the time, NRC is limited to compensation and appointments. Succession management is also an area which is being brought into a lot of focus. Other committees we have discussed a bit. I think we can move on. KMPs and SMPs. Again, KMPs, I think, very easy to define. Companies Act defined it. It includes CEO, MDs, company secretary, WTD. Section 203 is the governing section. Then RBI basically says that you simply takes the definition of the Companies Act. But again, there is a conflict of interest. And KMPs cannot hold office under any other NBFC, ML and UL. This was basically impacted a lot of companies which were working under group. Senior officials were sort of working in multiple entities. RBI is of a firm view that any NBFC should have an independent origin and identity to other entities in group. This is something which was brought in, and then there was a timeline window also given. SMP, I would say slightly tougher. There's a Companies Act definition which says member of core management team. Now, core management team is something which is very difficult to define. I think many people think that they are part of core management team, but some people think they may not be. There are some organizations who have defined a management team. Unless it is defined, I think it is very difficult. One level below ED, sometimes you also find junior people reporting one level to ED. That also becomes a difficulty. Then there is also a LODR definition, which is slightly different from it and much more expensive than this. It's always, I would say, a moving target, but most of the senior officials and the head of assurance function, irrespective of their grade, will be part of the SMP. There are compensation guideline principle for fixed and variable pay structure, malus and clawback provision. This is also being reviewed by RBI officials in much detail. Restriction in directorship, especially for independent directors and KMPs. Independent director cannot be with more than 3 NBFC, ML or UL. RBI reporting is also required within 2 working days. This again is a matter of debate. This 2 working days is usually taken from the date of last working days. Some people are of the view that it should be some date of resignation, but we see sometimes people, maybe not exiting after putting in their paper. So to exit is usually taken in when the person has formally exit from the organization. If we can move along. Now, these are some of the board approved policies. And again, these are the minimal set which is required. I've limited myself to the governance area. Some of the policies are customer facing, fair practice code for microfinance borrower, grievance redressal policy, integrated model and gradation of risk. Again, a very important area. Some companies have been levied penalty because they were not sharing this information. Charges and penal charges policy, interest rate policy, again, an important area. This is being reviewed very, very minutely by the regulators. Risk and compliance, KYC, AML, ICAP policy, and expected credit loss policy. There is also a guideline issued for money laundering and terrorist financing last year, October, under which ML and TF assessment need to be done at least, I think it is an annual or half-yearly basis. That is also gaining a lot of traction these days. NBFC per se are low risk with respect to money laundering and terrorist financing, but still this exercise need to be taken care of. There is a finance and operational requirement, liquidity risk management, lending against gold or silver collateral. Against lending against gold and silver collateral, there will be one small recommendation. Even if you are not doing it, better to take a board noting on it. It really helps. Then outsourcing policy, especially for companies which are working in group structure, code of conduct for DSA, DMA, and recovery agent. This is very important. I would say for recovery agent, this is more important. We need to have this specific code, otherwise it becomes, a little tough. Governance compensation policy need to be there, fit and proper policy, and internal guidelines on corporate governance. These are some of the policy which we need to have. We can move to the next slide and over to you, Aarti.
Thanks, Yogesh, for the wonderful insights. So, picking up from where we covered the board-related requirements, which Yogesh had just covered, moving on to the assurance functions. We already know this, but just as a quick reiteration, these are the three pillars of governance. So, your risk, compliance, and your audit are the three critical functions that RBI is really looking at to strengthen governance within the entities. So quickly, the requirements from RBI are they have to be independent, experienced, sufficiently senior, no dual hatting. Again, here, what is dual hatting or not dual hatting? There is some kind of debate amongst various entities, but I think we should go with the substance. And in substance also, there should be no dual hatting. Obviously, form there shouldn't be, but in substance also, there should be absolutely no kind of dual hatting. And finally, independent access to the board. Functionally, these functions report to the board or the board committee, and administratively, they have to report to the MD and CU. Risk, as we understand it, is for the identification, measurement, and mitigation. So I would look at it as risk is a forward-looking function. So a risk officer would typically ask, what if something goes wrong? Compliance, however, is more concerned about setting the guardrails in place to make sure that today I am compliant with all the regulations of RBI and other compliances. Finally, the audit is a backward looking to check whether we have complied with everything and whether we are operating as per the directions given by RBI as well as the internal policies and processes of the company. So all these three are complementary functions. It may appear that there is some overlap, but actually they are completely complementary in their activities and functions. The CRO is for all NBFCs with asset size of 5,000 crores and above. Compliance is for all middle layer and upper layer NBFCs. And the head of audit is also required for all NBFCs with 5,000 crores and above asset size. Okay, just some key pointers. What could we take care of? What are the regulators' concerns in some of these areas? So as we all know, governance is a major area of scrutiny. So RBI does look at this very in depth. Some of their queries may, like I think Yogesh mentioned it earlier, they are not expecting a tick box approach. RBI is looking at beyond compliance, beyond risk. They're looking at what should be the good to have, what should be done, what is the right thing to be done. I think that is the question we all need to answer. Is this good to do? Then do it. Sometimes it may look qualitative, but they are also looking at what should be done, but which was not done. Thirdly, not just minutes, but they look at agenda, the supporting papers. And I think one important thing to remember is your minutes and the agenda papers and the notes are the collective memory of the organization. Because tomorrow we may not be in the organization, but the minutes, the notes would speak. So I think detailed documentation is very important, minutes of the discussions. It has to clearly, bring out what was discussed, what were the directions given, and what action was taken. The CRO, CCO, and head of internal audit are also expected to have one-on-one meetings independently with the ACB or the RMC as appropriate. And these also need to be minuted and documented. Compensation related, we already discussed. RBI does expect proper policies on compensation, including the deferment, malus, and clawback related clauses. RBI does look extensively at the board related discussions and the quality of the board discussions. So, for example, what were the discussions on business strategy? What were the discussions in the RMC or in the audit committee on compliance and audit issues? Discussions on customer grievance, always a huge concern from the regulator's perspective, and rightly so. Human resources, attrition, training, financial integrity related issues, statutory auditor concerns, outsourcing, as Yogesh also pointed out, especially on the recovery and collection side, and functioning of the board committee. So I have cited the source also here, that, how RBI has every year, they have, how they have been deepening their scrutiny of regulated entities of banks as well as NBFCs and other REs. Yeah, next slide. Just, while we want to create extensive documentation, the concern also of regulators that don't create so much documentation that the board gets overwhelmed in it. Like this guy in the picture is, just created a whole lot of 500-page documentation and, hoping nobody will ask question. That is not the intent, but I'm sure the audience has understood what is the intent of proper documentation. Yeah. Next one. These are available on the RBI website. Some of the actions are clearly, while they are penalties, some of these also reflect on the governance. So when they say excessive interest rate has been charged, this is a clear concern from a fair practice perspective. RBI is very clear that core functions like credit, KYC, or internal audit cannot be outsourced. So there have been penalties on that. Similarly, if there is a change in shareholding in excess of 26% or change in directors of more than 30%, then you need a prior written permission of RBI. So this has to be thought through, because the permit you will have to write to RBI in a prescribed format that could take a couple of months. So you will need to plan this properly. And periodic review of fair practice, we already discussed this. So this is again, this could invite supervisory action. And appointment or any change of any key role or independent director has to be informed to RBI promptly. This little extreme here, but then I thought it's important for us to know from a governance perspective, because RBI does have a prompt corrective action framework for NBFCs as well. And they look at parameters like capital, tier 1 capital, as well as a net NPA ratio. And they have a set of actions that they take, including some mandatory actions. They could restrict business, as well as certain discretionary actions they could take on, like having a director, nominee director on board, or HR related certain actions. So there does exist a prompt corrective action framework for NBFCs. Yeah, next slide. I think to conclude the presentation here, this would be an interesting slide, because what better guidance to take than from the regulator, right? So Sri Sanjay Malhotra in his recent speech had said, no regulator can or should substitute for boardroom judgment, especially in a diverse country as ours. And I think that's a very wonderful and a mature comment from the regulator, where he is given a lot of flexibility for boardroom judgment, considering the diversity of our country, as well as even among NBFCs. There's a diversity of the type of, there's a gold loan NBFC, there is some NBFC into capital market, there's an NBFC into other finance, home loans. So RBI recognizes that, and he says that buck stops finally at the board, and the boardroom judgment is considered very seriously by the regulator. Shri Swaminathan, Deputy Governor, also made, he listed 5 points, and I thought it's very good to look at these 5 points, because they are very good, thumb rules for us to follow. One is the board must own outcomes. So like we earlier said, the buck stops at the board, and RBI looks at board and board committee functioning very seriously. Independence has to be real. So when we say they're independent directors, Yogesh rightly said conflict of interest. So that has to be looked at properly, and there has to be proper independence of the directors. Where there are conglomerates involved or large groups involved, RBI doesn't just look at the group. They don't just look at the entity, they look at the larger group. And so documentation, arm's length, related party related, compliances are key here. Protect and empower the control functions. We have spoken the 3 pillars, the 3 lines of defense. So any weak line of defense is a major governance issue, and it is considered a board failure. Finally, a governance gap analysis is good to have, that entities look at where we are and what we need to do to really make sure that our governance is where, and it, of course, it just the benchmark keeps increasing every year, but that is what is expected of the regulator. So I think with that, I would conclude this presentation. Thanks, Priya.
Thanks, Aarti. Thanks, Yogesh. We will open the floor for questions, and there are a few on the chat as well. But before that, I would like to get Mohinder sir in for a few of his thoughts on.
10 minutes, 5 minutes at least.
Yes, sir.
The macro
Mohinder
issue.
sir.
Yeah. What do you want me to speak on?
So it's all about governance, sir. Anything on governance, RBI expectation from NBFCs?
I must compliment Yogesh and Aarti first for having such a detailed presentation. Though I have heard Yogesh only partly, and Aarti, of course, I was there for the last 15 minutes. And they have dwelt upon all the relevant aspects what a company should do. I will only add that governance has not been defined. Governance is what is desired.
Yes.
What is desirable. Something in your view, governance may be like this, but what exactly is desirable? That is important. So just to add to, or you can say top up what Aarti has explained in detail, one has to think through. If one was in the shoes of RBI, and if the situation comes before you, how you would have dealt with that situation. That is what the governance is. Number 2, governance is to accept the mistakes and correct them instead of arguing. But best way to correct them is, I tell my all the corporate executives that RBI is only looking at papers, and the intent and the content of the corporate comes out of the papers. RBI officers are not sitting in your office, as she quoted the Governor Malhotra, that regulation cannot substitute the boardroom decisions. So how boardroom decisions are taken, this should be, I would say, adequately documented. What I have seen, even in large companies, that the board decisions are the managing director presented and the board noted the same. There was no deliberation. Even if there was no deliberation, I would have gone to the extent of putting words in the mouth of the directors. For example, if Aarti was the director, Aarti questioned this, Aarti raised this query, and it was answered by the managing director. There is no harm. And I would say that not a single resolution in the board goes without deliberations. Only thing is we don't record. So let us not only comply with the Companies Act requirement, let us comply with that we are a regulated entity. In case of Companies Act, nobody goes through the minutes, except in the case of adverse event in the company that, okay, SFIU comes or any ROC inquiry comes. In that case, only they look at the minutes. But in case of regulated entities, RBI comes, it's not necessary that you should be middle layer. RBI nowadays conducts off-site supervision also in all the companies, even though you are a small company, particularly those which are into fintech lendings. And the questions are so sharp that myself and Yogesh keep on arguing for days together what can be the best answer, and there can never be a best answer. It can be only what we can put our best foot. And going forward, we learn from that. So this much only at this moment. And let me see in case you have any questions, if in case I can answer those questions to your satisfaction.
Yeah, you can coordinate question answer.
Yeah.
Thank
Yeah,
you.
Raman, would you like to say something in the meantime?
Yes.
I will just queue up the questions.
No, I think we can go it straight away. But one thing more I wanted to inform people in the house. Mohinderji is very humbly sitting here. He is the architect of the entire regulatory framework of NBFC. Let me tell you, what started in '97, he was the key man there. I know him since then, so I think he has been all through very humble on this. So what he says are, I think, actual words of gold. Governance is all about what is not mentioned in the regulation. It's what actually desirable sitting as an outsider. I think that defines what is governance. Very well said, sir.
Thank you. I don't
Yeah,
know.
so
Luminaries are sitting here and they are dwelling upon the things. I know each one of you for a long, long time. Thank you very much.
thank you, sir. Yeah, so we'll open up the panel now for questions. I have a few questions on the chat which I'll take, but anyone who wants to voice their question can raise their hand and we will allow you to speak as well. So one question, can a holding company in manufacturing who has a head of internal audit also act as a head of internal audit for 100% subsidiary NBFC company? Or there is a requirement for a separate HIA for NBFC? AUM is 15,000 crores. Yogesh, Aarti, Mohinderji, anybody?
No,
So,
I leave it to Yogesh first.
yeah. So in my view, there must be a person sitting within the company. Had the AUM been, I would say, 1,000, 2,000 crore, less than 5,000, my view could have been different. But with a company with an asset size of 15,000 crore, I think the right expectation of RBI is there must be a dedicated person. Usually what happens in such a holding entity, I'm pretty sure there would be a senior person within the hierarchy who would be looking at the NBFC operation. I think they would need to take that route. A 15,000 crore asset size is sizable.
Well, let me
Thank
add,
you, Yogesh.
Yogesh.
Yeah.
Let me add, Yogesh, that the head of audit in a manufacturing company will not have NBFC experience.
Yeah.
So I top up your answer that head of audit has to be having NBFC experience. If the holding company was also an NBFC, then perhaps head of audit, because there is a provision in the directions that you can share the resources with the holding company, with the subsidiary and vice versa. So that head of audit could have been considered to be fit for NBFC head of audit. Considering that head of audit here is the head of audit of a manufacturing company, it doesn't qualify to be head of audit of an NBFC.
I think if I may quickly add a technical point here, 5,000 crores and above AUM, anyway, risk-based internal audit also kicks in.
Exactly.
So the risk perception of such a sizable NBFCs would be totally different than a manufacturing company. So I think there is, certainly I add on to what Yogesh and Mohinderji have said.
True.
Thank you. Moving on to the next question, why a role of CCO and a company secretary requires separation, as both the roles are entrusted to ensure compliance of applicable laws, and in fact, role of CS is even broader. Please share your views.
I'll share to start with, and maybe Mohinderji and Yogesh can add. So I think while regulatorily one could argue that that nothing stops a CS and a CCO from playing doing the same role. I think RBI does seem to have voiced concerns in certain cases, because as the NBFC grows in size, the view is that compliance has to be a dedicated function. And hence the CS is also involved with other responsibilities, and hence the feeling is that there could be a dilution in the role, and hence the recommendation that it should be separate. That is my views on this.
Again,
any further thoughts?
Just to elaborate a bit. See, again, one of the reason is that why CS role is little broader. I would say the roles are very sharply being defined. A CCO is not just limited with governance. A CCO and compliance function is also a business-centric function. A lot of our actions, deliberation, discussions happen with the business team, underwriting team, credit policy team, technology team, teams with which a lot of times secretarial team has limited interaction. And CS itself is a very, very critical function. It is a very critical function, especially for entities which are listed or debt listed, or anyways, there is a lot of governance element, and that is where RBI is coming in. Say that they are not saying that don't do both the role. What they are saying is that if every CCO or CS are Superman or Superwoman, because both two roles are so big, they are saying that maybe one person shouldn't be doing everything. That's my two bits.
Yeah. Yeah, and I think the point that there is an independent sort of an institute which governs the entire company secretaryship itself is an indication that a CS role is much broader and much more technical. A CCO's role is more technical from an RBI's perspective, where again it's a substance over form sort of a thing that has to happen, and CCO becomes a point of contact for everything that RBI needs to dwell upon, right? So that's almost like CCO becomes a spoke for RBI, and the company secretary has their own sort of technical reporting that has to be done. And typically, as the organization grows and scales, these two functions cannot be done by one person. It'll be too overwhelming for that person. I hope we've answered the question. Moving on to the next question. For independent discussion, we are covering. So this is I think more a practical question. They're saying we are covering for the independent discussion with the management. However, we're not capturing some of those discussions as the directors feel that some of those views should not be documented. So it's more on the last point that you mentioned about how the minutes and documentation should happen. So I think somebody's asking for a practical viewpoint in terms of while there could be some confidential discussions that happen during these closed door conversations between, say, the CRO and the board or the independent directors or ACB, there is sometimes a very specific requirement or request raised कि इसको document नहीं किया जाए. So what are your views on that?
I would like to just add in here that we have to sensitize the directors that this is a requirement of the regulator. And ultimately, like 4 pillars of governance, we said transparency is one of them. So this is definitely, it has to be minuted. There is a responsibility on both ends, the CCO as well as the directors. And it has to be documented. So what you could typically do is you have the minutes exchanged only between yourself and the directors who attended, so you don't have to keep the executive management in the loop. You just mark it to the directors who attended the discussion. But I think documenting that discussion is very crucial from a regulatory perspective.
Yeah, I agree with the Aarti. Again, one more practical input. If sometimes director may also feel that even no executive, including compliance officer, may be apprised. So what they can do is maybe keep the minute with themselves and send a mail that we have minutes. So if tomorrow, let's say, if Reserve Bank want to take a look at those minutes, they can be shared directly. But a record has to be kept. Ideally, a record must be there, and if not the complete record, a summary point discussion should be recorded. That if not the exact conversation that okay, all these points were summary kind of these points were discussed, that would usually serve. See, again, intent of officials who are supervising is not to know the minutest of detail which are happening in the company. What they want to know is system working? Is this independent meeting happening or is it a paper meeting? If it is happening, can we know 4 or 5 broad parameters which are there? How they can check it? Through some evidence. What is that evidence? Usually it is minutes. So sometimes even a summary point discussion can also help. But some evidence need to be there.
Thanks. And in today's day and age of technology, a lot of these discussions can anyways be digitally encrypted to make sure that it doesn't fall in the people or in the sight of people who are not supposed to know it. So I guess the regulators' expectations have to be upheld above everything in that context. There's an interesting question on HFC, Yogesh. It's about IIBF training. The question is whether it is a mandatory requirement to conduct the IIBF training for recovery agents or recovery teams, and whether, second question, IIBF allows trainings for recovery employees of HFC. It's your core subject.
Yeah, it's a two-part question. First is whether employees should take this training. I would say the employees which are customer facing, that is if any of our employees actually going to the customer and collecting money, then the regulatory expectation is that yes, they should be having this certification. Second is a much more practical question, because usually IIBF does not allow non-bank to become a member or non-bankers to become a member. I think there is an associate membership which is allowed by IIBF, under which non-banking institution can also become members and their employees can get this certificate. Not many people are aware of it, but this can be done. Some other work is also being done. I think probably in future, there may be a window for NBFC officials directly to get this certification. On that, maybe some kind of a work will need to be done. But to limited answer, yes. People who are directly going, meeting the customer should have this certification. That is the expectation.
Okay. Thanks, Yogesh. Slightly different question, more on the information and cybersecurity aspect. So can CISO also be a DPO, a data protection officer, I suppose, in a medium-sized housing finance company? Or the two roles have to be mutually exclusive? Again, while the question is from an HFC, I think it could be in the
Well,
minds
not
of
really an
NBFC
expert
officers.
on this, but I think DPO is still being talked about. It's a new animal in the zoo, so to speak. And I think for some time there will be dual hatting. CISO is, I think, one of the common position which is being talked about to take care of this responsibility. And till that time, I think there is more clarity. Maybe it's not a bad choice, but there is no clear confirmation. Well, I think we have to play it by the ear till the time this evolves a little bit more.
Okay. Thank you, Yogesh. There are two more questions. I think one, Mohinderji had addressed it. So, a very basic question on can a CS of a holding company be a CS of a subsidiary? Since Companies Act allows, in one subsidiary. However, RBI Core says employee base should be different. Do we have any views on this? I think it's a group NBFC structure. So, can a CS be common? Is a question. I think you had answered this, Mohinderji.
See, again, the question of CS can be common, because if the CS is only handling the Companies Act requirement, if CS is also having the role of compliance officer, then answer is no.
Got it.
Because as Yogesh said that, and you also mentioned that CS role is much wider, much technical. But there are some small companies where the CS is also designated as compliance officer, not the chief compliance officer. So in case these two roles are already there, then the CS will not be able to do the justice to the RBI compliances.
Understood. Thank you. Last question on the screen, at least. I'm not sure if anyone else has any questions. We have 2 more minutes. It's relating to DPDP, but there is an RBI connotation as well. I'm just going to read it out. DPDP refers to reasonable security safeguards, while RBI aligns with this existing RBI cybersecurity framework. So are banks and NBFCs expected to do additional DPDP specific benchmarks, stroke cybersecurity aspects? I think it's a very generic question, but any thoughts on the linkage?
I think, like Yogesh said, this is still a new animal. We are all still trying to figure it out. But RBI has, recently come up with some circulars on training on cybersecurity. It has come on Daksh, I believe. So for middle layer, it is recommendatory, and for upper layer, it is mandatory. And for banks also, I believe it is mandatory. So I think RBI is already taking a lot of actions to strengthen cybersecurity related initiatives from their end. Having said that, we should start complying with whatever rules are already in place, the DPDP as well as the IT governance standards. And I'm sure RBI would also come up with some more requirements in the days to come. So,
thank you.
My 2 bits on this is that there is also a proposal to make a data protection board. So that has to be constituted. When that board gets set up, I think there are going to be more consultation with the other sectoral regulators, not just RBI, SEBI, IIDI. There are many other sectoral regulators. One of the major impact sector which get impacted by DPDP is actually not BFSI, but that's actually a health industry, because HIPAA regulation will become applicable on them. So there will be Indian Medical Council and several other bodies. So I think this is something which is sort of still in motion. I'm 100% sure that considering the kind of data which is there with all of us. There are going to be additional safeguards which will be placed on us, but it may come in phases. Even now, 18 months are broadly given. So don't think so anything is going to come very soon, very quickly. But yeah, in future, I think definitely there will be.
Thank you. Thank you. We'll like to now conclude the session. I would invite both our chairman, Mr. Mahesh Thakkar, and Raman Agarwal to just, give some concluding remarks to close this session. Mahesh ji?
Thanks a lot. All the speaker, Yogesh, Aarti, and earlier DPDP, all were very good. In fact, and as Priya said, and Raman also said, we are starting this series. Every month we will have a webinar. And the purpose of that skill building will go great when people, you should participate more in numbers, circulate among your company, more executives can join. That will be the great thing. Thank you all. Raman.
I think all has been said. I'll just quickly add and do some marketing here that we also encourage all participants to ensure greater and greater participation in NBFC events and also enroll as membership. So we need to expand the membership base. It's in the common interest for all of us to have a strong inherent NBFC sector. So please spread the word around.
Yes, a lot of good work happening. So I think absolutely fair statement to make. We are already getting multiple inquiries through the webinar itself. So, but a word of mouth is much more faster than any of the social media channels, and we all know that. Thank you all. And there will be many such sessions we will do, all aspects being covered. So just watch the space for more action. Thank you. Bye, everyone. Have a good evening. Take care.
Thank you. Thank you.
Bye.